Welcome to the monthly economic wrap for February 2024. I'm Lee Wappling, and joining me is Jeremy McPhail, Head of Investments at FMD Financial. Jeremy, quick wrap of what happened in the month, economics.
Yeah, thanks, Lee. So inflation, GDP growth and employment or jobs market data came through in February, which were all of interest to markets. Inflation in Australia heading in the right direction, but easing in terms of the pace of change. So heading in the right direction for the RBA to consider what they do or reconsider whether they look to hike, pause or cut. I think the indications are still that they will probably likely pause and sit on their hands for a period longer. Jobs market from an RBA perspective is heading in the right direction, wrong direction from a consumer's perspective, which theoretically means the unemployment rate is increasing. So that breached through 4.1%. Still not at the same level as what it was pre-COVID, which was running at sort of 5 to 5.5% in the markets. Yeah.
But giving the RBA some confidence that the heat might be coming out of the job market.
Exactly right, yeah. And that's the signs they're looking for, inflation and the jobs market. They want to see the unemployment rate higher so that they've got more confidence that the inflation won't breach out of the high levels again.
Yeah, great. And what about the markets?
Yeah, so markets for Feb, it's an interesting month with reporting season, so it can be more volatile. So stock-specific volatility comes through, as we mentioned last month. Australian market was up 0.8%. It actually has significantly lagged other markets. So Japan, China up in the order of 6 to 8%. US markets up 5-6%. Here with reporting season, we're very bank heavy and resources heavy. They're not great earners at this point in time, and so that's held some of the markets back. And IT's certainly been one of the stronger performers in the markets, both offshore and here as well.
What about bonds?
Yeah, so bond yields started the month a little below 4% here and offshore, and ended the month in the sort of 4.1 to 4.2% range. That's bond markets suggesting that they were thinking rate cuts were coming earlier than what they actually have or will. So with the data prints that came through, with inflation not running down faster than what economies were expecting, and jobs markets still running relatively robustly, it's pushed out the expectations of when interest rate cuts may come through. So that's seen yields push out a fraction in the period.
Any movement in the Aussie dollar in the month?
No, again, very, very stable as well. So the RBA did a really good job of publishing information around how they assess the currency in the last update. And so there was insights around commodity prices and interest rate differentials, so the differences between our interest rates and interest rates overseas.
Yep.
And their modelling and suggestions are that the currency is probably around where it should be, if not a little bit undervalued. Where we are and what happened in the month was pretty stable from a currency perspective.
As you mentioned earlier, China had a strong month. What contributed to that?
Yeah, well, I think it's probably a bit of valuation opportunism from investors. So I think it's still a tough place to take conviction and invest with confidence. Capital flows would suggest that there were very strong capital flows pre-COVID and since then. The intervention, the regulatory intervention that's potentially there, and also some of the concerns around the property market over there that have been or had been overheated, have taken a bit of the positive tilt out of that market. Notwithstanding that, there are certainly some great valuation from an earnings perspective and an earnings outlook perspective in that country, which some people are taking advantage of at this point in time. It's not without risk though.
Yeah. And Japan's had some sort of record.
Yeah, so it's been a long time coming. So 34 years in the making. 1989 was the last time that the Nikkei was at the current level, which is an amazing long-term investment. If you comment that investment markets are for the long term, that's a very long turnaround.
So that's since 1989 when The Simpsons was launched.
Yeah, The Simpsons were launched, and the Game Boy was the game of choice for the gamers out there. So it's been a long time coming.
The Simpsons has gone on stronger.
yeah.
Is there anything in particular that's happening in Japan that's led to that?
Yeah, that's an interesting question. So the regulators over there have started to encourage businesses to look to deploy capital that's excess to what their requirements are. So there has been some regulatory change, if you like, that's come through to encourage lazy balance sheets, lazy businesses, and encourage a bit more of a growth-oriented outlook for companies there. And it's certainly having the desired effect that capital is either being redeployed back to investors, capital is being redeployed into growth opportunities for companies. And there's severe consequences for some companies that they do get derated or removed out of indices if they're actually not seen to be taking action.
Okay, so there's a lot of encouragement for them to get on with that growth story.
Correct, correct. And notwithstanding the fact that it's still a challenging economy there, that growth there is still hard to come by, and they've still got negative interest rates.
Yeah. And more broadly, Jeremy, what's your worldview at the moment?
It's interesting. I think it seems as though we're getting back to more normal levels on a range of different things. So interest rates are probably more normal where they are today, where they were in emergency settings through COVID. Probably a little bit of room to come down to add a little bit of stimulus to economies if it's required. But certainly from a growth perspective, growth in economies seems to be relatively robust. Jobs markets are still probably a little bit stronger than many would have predicted. But generally, most of the signs are relatively robust, that we're sort of heading back to a bit more of a normal environment as we've sort of peter out of this pre-COVID, through COVID, post-COVID phase where there was bubbles and contractions in many different places that were really hard to predict.
So perhaps it is a soft landing.
I think that's the suggestion, yeah. So certainly from a domestic perspective, and even if we do head into that recession phase, with the employment market where it is, so we may have a couple of quarters of negative growth. I'm not saying that we will, but if we do, we're in a very sound position from an economic perspective. The jobs market's not dire. Businesses are still employing people and not looking to do wholesale cuts. And so you'd be relatively confident that, yes, it will or should be some sort of soft landing.
Fantastic. Okay, what are we looking out for in March?
Yeah, so March, again, the main points that most people will be watching would be the inflation data points, some of the supply management and manufacturing services indices will come through as well. And the RBA will be publishing information from their latest meeting, their 6-weekly cycle. I'll get that one right this time. Their 6-weekly cycle means that their next meeting is the 19th of March. So mid-March we'll get some further information around how they're seeing the economy and what signs they're looking for. As we mentioned at the start, inflation and employment are the key factors that they're looking at the moment, and they're heading in the right direction for at least the RBA to consider probably pausing and being on hold until they get more signs that inflation will continue to ease.
Great. So sounds like interest rates and inflation are the key things we're focused on at the moment.
Absolutely.
Yeah.
And they're really the large determinants of the outlooks for markets, we think, at this point in time, that cash rates and bond yields are what set many valuations for different parts of the economy and different parts of markets. And so once we've got some greater clarity around when the pauses will come, when the cuts will begin, if they need them, then certainly markets will be considering that and what the next move may be.
Great. Well, that ends the February wrap. Look forward to talking to you again in very early March, Jeremy.
Great.
Thanks for joining me today.
Thanks, Lee. Cheers.
Thank you.